The headlines are everywhere. Tesla stock is down. It has fallen more than 20% from its recent high. This places it in what Wall Street calls a bear market. Investors are worried they are selling their shares. Fear is visible across the market. Reports show fewer new Teslas were registered in February. Europe, China. This news fuels the selling. It makes people think growth is slowing. Panic can set in, pushing the price lower. The steep decline shakes confidence. On March 20th, the stock closed below a key technical level, $380 a share, signaling more weakness. Some analysts now predict bigger drops. Gordon Johnson of GJL Research, 80% downside later this year. HSBC, a very bearish price target, potential 68% collapse by early 2027. Negative sentiment creates a cycle. It's worth thinking about. A falling stock price can be scary. It feels like you are losing money, but it is important to change your perspective. Think of it like a sale at your favorite store. When an item you have wanted goes on sale for 20% off, you do not panic. You see it as a chance to buy it for a better price. The same logic can apply to the stock market. A price drop for a strong company is not a disaster, it is a discount. You get to buy a share of that company's future earnings and growth for less money than before. This is where patience can pay off. The key is to separate the company from its stock price. A stock price can change every second. It is driven by daily news, emotions, short-term trading. The company, on the other hand, is a real business. It has factories, employees. The most straightforward reason to consider buying Tesla now is the price itself. The stock is currently trading around 378, which is down more than 24% from its 52-week high of nearly 500. This means you can buy a share of Tesla today for significantly less than what investors were willing to pay just a few months ago. This is not a small, unproven startup. This is the company that pioneered the modern electric vehicle market. It has a proven track record of scaling production and creating products that millions of people want. Buying a leader in a growing industry at a discount is a classic investment strategy. Think about the numbers. If you buy a stock at 498 and it goes up to 600, you make a profit of about 20%. That is a good return. But if you are able to buy that same stock at 378 and it goes to 600, your profit is over 58%. The company's performance is the same in both scenarios. The only thing that changed was your entry point. A lower entry price magnifies your potential returns if the company succeeds. It also provides a larger margin of safety. If the stock falls further, your loss is smaller than if you had bought at the peak. This is not a prediction that the stock has hit its bottom. It could certainly go lower. However, for an investor with a long-term horizon, trying to time the exact bottom is nearly impossible. A more practical approach is to recognize when a quality asset is trading at a price that is reasonable relative to its long-term prospects. When you buy a share of Tesla, you are not just buying a car company, you are investing in a technology company, you are investing in an AI company. The biggest part of this story is the potential of full self-driving and the creation of a robotaxi network. This is the factor that many bullish analysts point to as the real game changer. While car sales generate one-time revenue, a fleet of autonomous vehicles could generate recurring revenue every single day. This would transform Tesla's entire business model and could unlock a valuation far beyond that of a traditional automaker. Think about the economics. A personally owned car sits parked for about 95% of the time. It is an underutilized asset. A robotaxi, on the other hand, could be in operation for most of the day and night, generating fares. Bank of America analyst Alexander Perry believes robotaxi services account for about 52% of Tesla's total value. He sees Tesla not as a car company, but as the leading consumer autonomy platform. This is why his firm has a buy rating on the stock with a price target of 460, viewing the current weakness as a chance to invest in this future. Reason 3. Dominance in production and brand power. Beyond the exciting future of AI, we cannot ignore Tesla's current strengths in the physical world. The company has achieved a scale of production that its rivals are still struggling to match. Building cars at a massive scale is incredibly difficult and expensive. Building batteries at a massive scale is especially difficult and expensive. Tesla has already invested billions into its gigafactories around the world: Texas, Berlin, Shanghai. This scale gives it a significant cost advantage. It allows Tesla to produce batteries more cheaply than many competitors. It allows Tesla to produce vehicles more cheaply, protecting profit margins. This manufacturing expertise is a powerful moat. Many new EV startups have great designs. They often fail when they try to scale production. Tesla has already gone through this painful process and learned valuable lessons. This experience is a competitive advantage that's hard to quantify but incredibly important. Furthermore, Tesla has one of the strongest brands in the world. The brand represents innovation, performance. Acknowledging the serious risks, it is crucial to be balanced. Investing in Tesla right now is not a guaranteed win. There are significant risks every investor must understand. Ignoring these risks would be irresponsible. The first and most immediate risk is weakening demand. The numbers do not lie. New vehicle registrations in the European Union plunged 17% in February. UBS has cut Q1 2026 delivery estimates. They cite a persistent demand winter in major markets. If people buy fewer cars, Tesla's revenue and profits will fall, and the stock price could fall further. The second major risk is valuation. Even after the recent drop, Tesla is not cheap by traditional metrics. Forward price-to-earnings ratio, 194. Sector median, 15. S&P 500, average, 22. That implies very high expectations for future growth. If growth slows even slightly or profit margins shrink, the stock could be punished severely. Crafting a prudent investment strategy. High potential rewards, serious risks. How should a thoughtful investor approach Tesla today? Don't rush in, don't run away, have a clear, deliberate plan. Step 1. Check your financial situation. Check your time horizon. Not for money you need back in 6 months. This is a long-term investment. Only invest money you can leave untouched for at least 5 years. Gives Tesla time to navigate current challenges. Gives time for long-term strategy to play out. Step 2. Manage your position size. Don't put all your investment capital into one stock. Diversification is key to managing risk. Allocate a small percentage to Tesla. If it does well, you get a boost. If it falls, your plan isn't devastated. Step 3. Consider buying in stages. This is dollar cost averaging. Don't invest a lump sum all at once. Section 8. Conclusion. A calculated bet on the future. We stand at a crossroads with Tesla. The market is filled with fear. Falling sales, intense competition, a broader rotation away from high-growth tech stocks. The headlines are bearish. Many investors are selling. This has pushed the stock price down significantly. That drop could be a compelling opportunity for long-term investors. The current price reflects short-term pessimism. The question: do you still believe in the long-term case? There's no single right answer for everyone. On one hand, reasons for optimism are clear. Tesla is the leader in electric vehicles. Manufacturing scale, battery technology, brand recognition. More importantly, Tesla is in the race for full autonomy. Autonomy could reshape transportation and create trillions in value. Buying today gives exposure to that upside. Analysts at Bank of America, analysts at Wedbush. Enjoyed this? Please like and subscribe for more videos like this.